As of early October 2024, both the S&P 500 and NASDAQ are navigating a mixed landscape. The S&P 500 has seen solid gains through 2024, buoyed by falling inflation and resilient job market. A robust corporate earnings growth of around 8.8% for quarter two. Technology and communication sectors continue to lead, particularly fueled by ongoing enthusiasm around AI. However, higher interest rates have created headwinds, especially for small caps and rate-sensitive sectors. The NASDAQ, benefiting from tech-driven momentum, performed strongly in the first half of 2024, supported by AI-driven optimism. But valuation concerns for mega-cap stocks like Apple, Microsoft and Nvidia are rising, leading to expectation that smaller companies might outperform as the year progresses. While the Federal Reserve pivot towards rate cuts is anticipated, the pace will be measured with concerns around rising unemployment and geopolitical risks adding complexity. Welcome back to another update, and today we're looking at the S&P 500 and the NASDAQ, and here we've got the S&P 500 on the monthly, the weekly and the daily trends. On the monthly, we're still bullish. The price is still above its moving averages, and likewise the CCI 150, which is also above its moving averages, although it looks like it's going to break into that in the coming days or weeks possibly. Now we also have if I zoom out on the monthly first off, we also have a bearish divergence on the CCI 150 versus higher highs on the price, and that indicates at some point we're going to see a bit of a retrace to the downside. Not necessarily a crash, but a retrace similar to these. So where it stops, we're not sure yet, but as soon as that starts retracing, we'll start measure it. Then we'll measure the Fibonacci retracement. On the weekly, again, we've got another bearish divergence. There was one here actually in between those peaks. It fell off, and you can see there it fell off and hit that range there. Now if I was to draw a Fibonacci, let's see how close it got between that peak. You can see there it broke and bounced off that 38%. Our minimum retrace level is always the 23, between that 23 and the 38% level retrace. That's a minimum. In this case it hit it exactly, then it bounced from there. So where we are at the moment, we've got another bearish divergence there. I'm not going to draw the trend line, but you can see the peaks there are declining versus higher highs in the price. And again, we haven't seen a pullback yet, but as soon as you start seeing a pullback, then we'll start measuring it. That's the weekly. On the daily, it's also hit this key resistance at 57.73. It's having trouble punching through that. And again, we've got a bearish divergence longer term here. Lower highs versus higher highs on the price. So again, that'll be our early indication. Now, it's already broken to the downside on the CCI here, but it's now in that neutral range within the moving averages. If we go to the micro view, using the daily as a reference, we don't take any long or short trades until we see the daily CCI break either above the moving averages or below. At the moment, it's neutral, so avoid going long or short. Now, in the last, since the start of October, it was bearish. So if we turn on the bearish signs, you can see there, since the start of October, you would have taken a couple of nice little trades. And the way to execute those, you execute when it breaks below the moving average of the price chart, but also the moving average of the CCI. Enter a trade, and you close it out a couple of ways. You can wait for it to break through the moving averages of the price chart, but sometimes that's a bit risky. I prefer to get out a bit earlier and close it when it breaks into that moving average of the CCI, and then enter it again once it breaks below that CCI moving average range again. So you could have taken a couple of small trades there as well. At the moment, again, as I said, don't take any long or short trades until we see the daily confirm and break above or below that moving average range. The price chart is already bullish, so the CCI is just giving us a bit of a neutral signal. The NASDAQ on the trends of the weekly and the monthly and the daily are giving us similar view. On the monthly, we've got a bearish divergence, very strong bearish divergence there versus high highs in the price. And I've already drawn a retracement target there, a bit too early probably, but I'd like to see this retrace to the downside. It almost came close with that big wick on the candle there. But again, the price is still moving to the upside, even though the CCI is dropping off on the monthly. On the weekly, we've also got this, we did have this bearish divergence long term versus the price making new highs, and more recently we've got, that's not a bearish divergence because the CCI is dropping and so is the price, hasn't gained new highs yet. If that price breaks higher than that previous high and that CCI keeps dropping, then we'll consider that a bearish divergence. But at the moment, the weekly is neutral. It's in that moving average range of the CCI, even though the price is above the moving averages. On the daily, again, it's hit this resistance at 2760 and hasn't quite penetrated through that yet. There's no divergence, bullish or bearish, to talk about yet. The daily is currently neutral. It's in a very thin moving average range there, although the price is just above its moving average, is giving us a slight bullish to neutral positioning on the daily. So avoid going long or short on the intraday time frame. So again, looking at the daily as a reference, you would have taken short trades on the intraday based on the daily there and then converted to long trades. So let me just look at back here. That would have been from the start of October. You would have taken bearish trades. So that could have been an entry you could have made. It would have been probably stopped out, or maybe, yeah, that would have been stopped out because it went against you straight away. Going back to that was the start of October 2nd. So it would have been from there. You might have got into a trade there possibly, October 2nd on the 1 hour chart, and you would have probably got stopped out on that one. But since then, during probably October last Friday, had you made trades in on Friday, you would have got a couple of trades there, and you'd still be in a trade today. Now, at the moment, you'll notice the price and the CCI are both above their moving averages, and if you went long on that one there, you'd still be in a trade, and you would have closed it out as I'm currently talking. That would have been a close, because that's broken into that moving average range on the 1 hour time frame. You can apply this same logic to the other intraday times, like the 2 hours, the 4 hours, or even the 15-minute, etc. To support the channel more, hit that like and subscribe button and share the video. For added benefits and the cost of a coffee, consider subscribing to the Patreon page, where we look at weekly scans of bullish trending shares and insider trades that may have occurred. Thanks again, and see you in the next video.